One of the things that I love about One Rental at a Time, and frankly, hopefully, I hope you appreciate, is our guests are active in the business. And sometimes it is when they are on the road. It is important for our guests to come on each and every week, and they will sometimes just pull over and talk to us in the car. We have one such day today. Jonathan, how you doing, buddy?
I'm all right. How are you?
I'm doing very good. So as long as the audio keeps up, we are going to make this happen. I don't know if you saw this, but there was something I listened to on CNBC. I think it was Tuesday evening. Kumal Shri Kumar is a has a PhD in economics and I guess runs a analyst firm. But he said something that stopped me in my tracks. He said his base case for 2025 is the 10-year will end the year at 5%, which frankly is not all that crazy. We've been there before, so I could see how someone gets there. But what he said next had me stop what I was doing. He said the risk to his call is to the upside, and he said his upside call is 6% 10-year. I cannot fathom the amount of things in our leverage system that would break at 6% on the 10-year, let alone what you and I play with every day, mortgages. That would mean most mortgages are 9% and investor loans are 10%. So let's talk about higher for longer, because things might get a lot worse. Even if we end up at 5.5, you split the difference on the 10-year. That's painful. Yes.
Yeah, absolutely. And the market is kind of shown that to us, a glimpse of what it might look like if there was a drastic shift up, right, in the last 2 weeks. Because leading up to it, for the people that remember, 2 weeks ago we were talking about five something handles, and now we're talking about high six handles to seven handles, right?
Yep.
That shift happened where we only really enjoyed handles and the handles for like 2 business days, maybe 3 business days. And if you didn't catch it then, it shut up. So I think what we're seeing is the market itself is telling us like if there's downside, they're not going to reassess to the downside as much as they will reassess when it's the upside. Because in the non-QM market, what's crazy is when the rates were shooting down, the rates didn't drop that much, right? In comparison to like conventional, obviously. But as soon as it shifted, everyone started pricing up because they wanted to protect their margins. And now
Yep.
they're going to market to sell these properties or sell these loans, right? That they locked and closed at like fives and sixes, like low sixes. And then now the market isn't going to be showing and proving that you can sell these loans at like fives and sixes anymore. So if you can't sell the
Yeah.
loans for fives and sixes and you have to sell it at a loss, now everyone's trying to cover their margin basis. What we saw was the market just flipped upside down and just went up.
Yeah, yeah. Again, this again in a rate environment where we were, getting, I was talking about doing a portfolio loan if rates were going the right direction. They obviously flipped on a dime. You're absolutely right. It was a 48-hour window where you could get something in the fives. Now we're talking sevens, and if we look out and things go wrong, if we're talking 8, 9, 10 for investor loans, that's going to change a lot of equations. It's going to decrease demand. It's going to increase. It'll frankly increase opportunity because motivated sellers need to. But where everything breaks down is the commercial market, right? We have been talking about extend and pretend in the commercial market for years now. A lot of banks will stop pretending. If the cost of capital is truly 9% for investors, banks will just start foreclosing in mass because nothing is going to save them. Their hope with extend and pretend was rates would go down. If rates explode higher, I predict mass foreclosures in Class B and Class C multifamily. What do you think?
Yeah, absolutely. And I actually had an interesting call with a service provider that does a lot of default loan packaging like assessment in terms of valuations for the properties. And he's obviously the numbers for like foreclosures and like, is like kind of up, right? But he said the scarier number is on the residential side as well. He's starting to see more and more properties being called upon for default reassessments. And
Mm,
I mean, his number's a little inflated, I think, which is like 12%, he was saying, which is really, really high, but that's like concentrated to what he's working on because all he
yeah,
sees are defaulted loans. But
right.
I think that that's obviously everything small, everything starts in the micro and then spreads out. So I think in targeted markets where he's starting to see a lot more defaults go up, we're going to see that start to translate into, like you said, more distressed sellers. And even we are starting to get a lot of notifications of like, hey, so and so hasn't made their payment, so and so hasn't made their payment. Like we're starting to get notifications of that as well because we get
Mm,
notified as soon as like let's say the 15th hits and they haven't made a payment. So what that tells us is overall wise, there's a little bit of a concern, right? Everyone is kind of like holding on tight to whatever they can. And
yeah.
the uncertainty is as high as ever, right? So if again, the scary part about all this is if default rates, especially in the non-QM side, go up, then lenders and the Wall Street and hedge funds, like they're not going to want to lend at a lower margin anymore. They're going to bump everything up to make sure that they can meet the demand first, but also make a profit, right,
Hmm.
on the actual loans that they're packaging up. And that
No,
means that it's
no
higher
question.
rates for everybody. Yeah,
No, there's
or
no
loans are gone.
question.
Like these programs might be gone.
That's exactly what I see coming. Again, this is almost repeat of what we saw. I think it was in 1819. The market flipped. The loans that they were doing were unprofitable. They had to sell at a loss, and non-QM space just dried up. They had to reassess. They had to do something different. So I actually totally agree. The first thing that would happen is programs will disappear. Then they will come back. They will be more expensive with lower leverage. Higher rates breaks a lot of stuff. It will create a lot of opportunity, but there will be a lot of pain, a lot of losses. Why don't we talk about some more details of what's going on right now? Why don't you talk about the risk of retrading? What is retrading and what's the risk?
So retrading means that you locked at something, and this more happens on the non-conventional side, but you lock
Mhm.
something, let's say you locked 5% like 2 weeks ago, right?
Okay.
And then let's say your loan process and it expires, or the lender all of a sudden sends an emergency notice and says, sorry, can't offer that rate anymore. Now
Mm,
you have to relock to what the market is. So
got it.
essentially, what it is you're they're forcing you to change your rate and your terms because there's no longer the ability to make a profit on that rate.
Yeah.
So what that means for a lot of people, right, is if they're in process and they get retraded on, then unfortunately, people are going to have to take the new terms that are, new terms that come into play versus what they had previously.
Yeah.
And the
It's
risk the risk of that, yeah, the risk of that is, you know, the market conditions right now as it stands, if you had something that cash flowed or you margined everything so that it would be at that level of break even or a little
mhm.
above break even, like whatever you were talking about, those margins are going to get even more squeezed.
Yeah, in an environment where we see drastic rate movements, and again, we've seen some historic levels of rate movement up and down. This risk of retrading is real, and frankly, again, what I think Jerome Powell said it in his interview on Wednesday. This non-bank lending or non-bank credit area where non-QM plays hasn't really been through a recession. It hasn't been through what he called a credit event. And we're gonna see, and you never know if this credit event gets nasty enough. Plenty of folks could blow up. It's happened before, and I'm sure it will happen again. So that's why people will be retrading because they don't want to do a loan at a loss. Why don't you talk about cost of averaging down?
Sorry, I lost you for a sec right at the end.
Nope, just talk about cost of averaging down.
Oh, yes, yes. So, obviously we spoke 2 weeks ago, and I think kind of last week on actually cashing out to be able to deploy the capital. And we've been talking to a
Mhm.
lot of clients about that. In this rate environment, the number one question I get asked is, where do you think rates will go in the next 90 days? right? And there's no
I
way
have no
for me
idea.
to know. Yeah, there's no way for me to know. There's no way for anyone to know, actually, because and if the last 2 weeks, last 3 weeks has taught anyone anything, it's that nobody actually knows what's going to happen, right? So, in especially in the rate mortgage rate environment. So what we're telling clients is, look, you have a portfolio of 10 properties, let's say. You want to pull out cash to be able to deploy and purchase and utilize the capital to, make a return on a new investment because the market still is great for investors, right? Then you take, let's say, one or two of those properties that have equity, maybe tap into the equity of those one or two properties, pull it out, use it, and then if you feel like, and I say that very carefully because I don't want them to say that no, Jonathan told me rates are going to go lower. If you feel like rates are going to go lower, then you can cost average down, like you buy stocks at a lower price, right? If you buy a stock at a higher price, buy a stock at a lower price, your average cost goes down. You do the same thing with your portfolio in a way, and you pull out a little more cash from two or three more properties, do what you need to do, and then, your average, when you look at your profit and loss for the entire business, let's say if you have a whole portfolio and you're looking at it as a whole, then you're going to see it kind of average out in terms of returns wise, just from the difference in rates. If you feel like rates are going to go down, if you don't
Yeah.
feel like rates are going to go down, then you can just pull out all the cash right now and deploy it and then cost average it with the property you're actually buying or the assets that you're buying with the greater returns because it's a different market that's better.
Yeah, folks, at the end of the day, we are in a very interesting rate environment, frankly, lending environment. Run your numbers, write disrespectful offers, make sure they cash flow day one, protect yourself. But again, remember, anytime we're in an environment that's chaotic, lots of opportunities are made and created because most people aren't really investors. They're very emotional. They stick their head in the ground. They make emotional decisions. Real estate is an amazing asset. I actually like the fact that it's not liquid. It takes time to sell. So again, let's at least keep our heads about ourselves. Let's work with professionals like Convoy Home Loans and Jonathan, and let's see if we can't create deals of a lifetime. That's what I want for you. Jonathan, how can they find you?
Go to convoyhomeloans.com and let us know you came for more at.
Yep, folks, convoyhomeloans.com. There's a little blue button that says more info or something like that. Click that. Bottom of the screen, it says, where did you hear us? Say ORAT. Why is that important? It's because you want to deal with this guy or his partner, Dustin. You don't want to go in a queue behind all the normal people. You want to be a VIP. So say you came from ORAT. Take care. Thanks, buddy. Thanks for stopping and pulling over.
Thank you.